Close your eyes for a moment and imagine standing at the edge of a vast marketplace, one that never truly sleeps, one that hums with energy every single day. A marketplace where millions of people are buying and selling pieces of real businesses at real prices, hoping, guessing, calculating, and sometimes simply following the crowd. Now imagine that somewhere inside this massive, noisy, emotional marketplace, there is a quiet system, a set of rules built not on feelings but on data, not on hope but on evidence. A system that has been tested across decades and across different countries and across every kind of market storm you could possibly imagine. That system exists. This audiobook is about that system. What you are about to hear is not a get-rich-quick story, and it is not a tale about lucky bets or brilliant hunches from a genius on Wall Street. This is something far more powerful than that. This is a story about discipline, about mathematics used in a human way, about finding real value in a world where everyone seems to be chasing noise. Wesley Gray, the author of Quantitative Value, spent years studying the greatest investors in history, including Benjamin Graham and Warren Buffett, and then he went further. He asked a very important question, one that almost no one was asking at the time. He asked, what if we could take the wisdom of the world's best value investors and turn it into a system that removes human emotion from the equation entirely? What he found changed the way many serious investors think about markets. This is where the journey begins. You do not need to be a mathematician to understand this book. You do not need a finance degree. You do not need years of experience on Wall Street. What you need is an open mind, a willingness to challenge your assumptions, and a genuine desire to build wealth in a way that actually works over the long run. Think of what you are about to hear as a conversation with a brilliant mentor. One who has studied every major mistake investors make, one who has tested every theory with real data, and one who is generous enough to share the entire playbook with you, step by step. By the time you finish this audiobook, you will understand how to find companies that are genuinely cheap, genuinely healthy, and genuinely worth owning. You will understand why smart people consistently make terrible investment decisions, and how a simple rules-based system can outperform even the most experienced human stock pickers. Not sometimes, but again and again across time. So let us begin. Chapter 1. The Paradox of Dumb Money. Picture this. A very intelligent man, someone who has spent 20 years studying finance, who reads every financial report with careful attention, who follows the news every single morning with a cup of coffee in hand, someone who talks to company executives and analysts and listens carefully to every earnings call, decides to invest his life savings into a stock he believes is about to rise. He is confident, he is educated, he is experienced, and he is wrong. This is not a rare story. In fact, the history of financial markets is filled with stories exactly like this. Brilliant people making terrible decisions with money, Nobel Prize winners losing fortunes, hedge fund managers with entire research teams underperforming a simple index fund. This is the paradox at the heart of Chapter 1. The paradox goes like this. The more intelligent, informed, and emotionally involved a person is in their investment decisions, the more likely they are to make behavioral mistakes that hurt their returns. In other words, being smart does not automatically make you a good investor. In many cases, it makes things worse. This is where most beginners make a mistake, and where even experienced investors stumble. They believe that working harder, thinking more deeply, and gathering more information will naturally lead to better results. But markets do not work that way. Here is why. When you invest money, you are not just analyzing numbers. You are entering into a battle with your own psychology. Every time a stock falls in price, your brain sends a fear signal that says, "Sell now, protect yourself." Every time a stock rises, your brain sends a greed signal that says, "Buy more, you are winning." These signals feel very real. They feel like wisdom, but they are almost always working against you. Wesley Gray calls this the problem of dumb money, but he is not calling investors stupid. He is saying something far more interesting. He is saying that the human brain, which is a remarkable instrument built for survival, was simply not designed for the modern financial marketplace. Imagine your ancestor thousands of years ago walking through a forest. He hears a loud noise and immediately runs. That quick reaction saved his life. The same instinct applied to a falling stock price causes him to sell at exactly the wrong moment. This is the paradox of dumb money. The investor who acts on every feeling, every news headline, every rumor and prediction is not an active investor. He is a reactive one. And reactive investing is expensive. Now, here is something fascinating. Studies of investor behavior show that the average individual investor consistently earns far less than the funds they invest in. You read that correctly. The fund itself goes up, but the investor who holds that fund ends up with much less, because they buy when they feel excited and sell when they feel afraid. They buy high and sell low, not because they want to, but because their emotions lead them there every single time. Think about a real-world example. In the year 2000, technology stocks were flying. Everyone was talking about the internet revolution, about how everything was changing, about how these companies would be worth trillions. Ordinary people, smart people, doctors and teachers and business owners poured their savings into technology stocks at the peak of the bubble. Then the bubble collapsed. Then, in 2008, real estate seemed unstoppable. Everyone knew someone who had made easy money flipping properties. Then that collapsed too. In both cases, the dumb money flowed in at exactly the wrong time, drawn in by emotion, by the feeling that something was obviously going up and would continue to go up forever. This is where most beginners make mistakes. They follow the crowd. They follow the feeling. They trust their gut in a situation where their gut was designed to do something completely different. So what is the solution? Wesley Gray argues that the solution is not to try harder, not to read more news, not to hire better analysts. The solution is to remove the human decision-maker from as many investment decisions as possible and replace that decision-maker with a tested, systematic process. This is not a new idea. Benjamin Graham wrote about it decades ago. Warren Buffett built his early fortune using principles very close to this. But what Gray and his co-author Tobias Carlisle do in this book is take that idea and push it further than almost anyone else has gone before. They build a system, a real system, one that any investor can understand and apply. But before we get to the system, we need to understand why value investing works in the first place. And that brings us to Chapter 2. If Chapter 1 showed you the enemy inside every investor's own mind, Chapter 2 is going to show you the weapon that actually beats the market over time. It is a weapon that has been hiding in plain sight for nearly a century, and almost no one uses it properly. Chapter 2. Value Strategies Beat the Market. Imagine two companies. Company A is a technology darling. Everyone is talking about it. Its stock has doubled in the past year. Analysts give it glowing reviews. It appears on the cover of every major financial magazine. Investors feel proud to own it. Company B is a boring, old-fashioned business. Nobody talks about it at dinner parties. Its stock has fallen over the past year, and people assume something must be wrong. Analysts barely cover it. Most investors have never heard of it. Now here is the question. Which company is the better investment? If you said Company A, you are thinking like most of the market. And most of the market, as you are about to discover, is consistently wrong about this exact question. The answer, over and over again across history, has been Company B. This is the core insight of value investing, and it is the foundation of everything Wesley Gray builds in this book. Value investing, in its simplest form, is the practice of buying assets for less than they are actually worth. It sounds almost too simple to be a strategy. Of course, you should buy cheap things and avoid expensive things. Every sensible shopper in a grocery store understands this. But in the stock market, humans do exactly the opposite, almost all of the time. Here is why. When a company is doing well, when profits are rising and headlines are positive, investors feel safe buying it. The price goes up. Other investors see the price going up, and they buy too. The price goes up more. This cycle continues until the price is far above what the business is actually worth. When a company is struggling, when profits fall or there is bad news, investors flee. The price drops. Other investors see the price falling and they sell too. The price drops more. This cycle continues until the price is far below what the business is actually worth. Value investors step into the second situation. They look at a business that the market has beaten down and they ask a very different question from everyone else. Not, why is this falling, but, what is this business actually worth, and is the current price giving me a genuine bargain? Benjamin Graham, who is widely considered the father of value investing, developed this idea in the early 20th century. He called it the margin of safety. His core idea was that if you buy a business at a price significantly below its true value, you have a built-in cushion against mistakes and bad luck. Warren Buffett learned from Graham. He then combined Graham's margin of safety idea with the concept of business quality. Buffett would say that it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. Gray takes both of these ideas and asks the next level question. Not should we invest in cheap quality companies, but can we build a system that finds them automatically, consistently, without human emotion getting in the way? And the evidence says yes. Academic research going back decades shows that stocks which are cheap relative to their fundamental value, meaning cheap relative to what the business earns or what assets it owns, consistently outperform expensive stocks over long periods of time. This is not a small difference. The gap between value stocks and expensive growth stocks over decades is substantial. A person who systematically bought cheap, fundamentally sound businesses over 30 or 40 years and resisted the urge to chase exciting growth stories would have built wealth that most investors can only dream about. But here is the important thing to understand. Value investing is not comfortable. It requires buying things that feel wrong. It requires holding assets that look unpopular while everyone around you is getting excited about something else. It requires genuine patience and a stomach strong enough to sit through extended periods where your approach seems to be failing. This is why most investors, even those who intellectually believe in value investing, cannot actually execute it in practice. Think about a real-world example. In the late 1990s, value investors were badly underperforming. Technology stocks were soaring. Anyone who held cheap, boring companies looked like a fool. Warren Buffett was publicly mocked in magazines for missing the technology boom. People said he was out of touch, that the old rules no longer applied. Then the bubble burst, and those cheap, boring companies held their value while technology stocks lost enormous amounts of their worth. The investors who had stayed disciplined through the pain were eventually vindicated, but the journey was not easy. This is why this matters in real investing. It is not just about knowing that value works. It is about having the conviction to hold that strategy when everything around you suggests you are wrong. Gray's contribution is building a system that makes this easier. By removing personal judgment from the process and replacing it with tested rules, the system keeps you disciplined even when your emotions are screaming at you to change course. If you are starting today, begin by asking yourself honestly, can I hold a strategy that feels uncomfortable for 2 to 3 years without abandoning it? If the answer is yes, you are already ahead of most investors. Now, understanding that value strategies work is the beginning. The deeper question is, why does human judgment consistently fail to capture these gains? Why can intelligent, informed people not simply look at the data, decide to be value investors, and then execute that plan? The answer lies in the fascinating and sometimes frustrating world of behavioral finance. And that is exactly where Chapter 3 takes us. Chapter 3. How Quantitative Investing Protects Against Behavioral Errors. Let us do a quick thought experiment. Imagine you are holding a stock that you bought for 10 units of currency. It has now fallen to 7 units. Your research tells you the company is still fundamentally sound. A systematic model tells you to hold, and perhaps even buy more. But every morning when you open your portfolio and see that red number, you feel a knot in your stomach. Your colleagues are asking if you are okay. Your spouse has noticed you are sleeping less. Your gut is telling you to just sell it, stop the pain, move on. What do? This is not a test of intelligence. This is a test of psychology. And this test is far harder than any multiple-choice exam you have ever taken in school. Behavioral finance is the field of study that tries to understand why human beings make systematically irrational decisions with money. And it turns out, we make them constantly, predictably, and in ways that are deeply wired into our brains. Wesley Gray identifies several of the most damaging behavioral errors that investors make. The first is overconfidence. Humans consistently overestimate their own ability to predict the future. Studies show that when people are asked to make a prediction and then rate their confidence in that prediction, they are wrong far more often than their confidence levels suggest. Investors in particular tend to believe that their research and analysis gives them an edge that statistics do not actually support. Think about it this way. If you walk into a room and ask every investor there whether they are above average, most of them will raise their hand. Statistically, this is impossible, but psychologically, it is completely predictable. The second major error is loss aversion. Humans feel the pain of a loss roughly twice as strongly as the pleasure of an equivalent gain. This means that losing 10 units of currency hurts twice as much as gaining 10 units feels good. As a result, investors hold on to losing positions far too long, hoping they will come back rather than cutting losses and deploying capital into better opportunities. The third error is recency bias. We tend to believe that whatever has happened recently will continue to happen. If the market has been going up for 2 years, we assume it will keep going up. If a stock has been falling, we assume it will keep falling. This causes investors to buy at peaks and sell at troughs, which is literally the opposite of what value investing demands. The fourth error is confirmation bias. Once we have formed an opinion about a stock or a company, we tend to seek out information that confirms that opinion and dismiss information that challenges it. This is how investors hold on to terrible investments long after the evidence has turned against them. And the fifth, perhaps the most interesting, is narrative bias. Humans are story-loving creatures. We find it very difficult to buy a stock if we cannot tell a compelling story about it. This means we are naturally drawn to exciting companies with great narratives, and naturally repelled by boring companies with no story at all. But as we saw in Chapter 2, boring and cheap is often exactly where the best returns hide. A quantitative system addresses all 5 of these errors in a remarkably elegant way. When you use a rules-based system to make investment decisions, the system does not get overconfident. It does not feel the pain of a paper loss and start second-guessing itself. It does not look at recent performance and assume it represents the future. It does not seek confirming evidence while ignoring contrary data. And it does not require a compelling narrative to add a stock to the portfolio. The system simply follows the rules, every time. Without emotion, without hesitation. This is enormously powerful. Imagine a real-world scenario. A professional fund manager and a simple rules-based system are both analyzing the same universe of stocks. The fund manager has an MBA from a top university, 20 years of experience, and access to more information than you can imagine. The system has a set of tested rules and historical data. Research consistently shows that in most cases, the simple rules-based system outperforms the brilliant human expert. This is not because the expert is unintelligent, it is because the expert is human. And being human comes with a set of predictable biases that no amount of education or experience can fully overcome. This is where most beginners make mistakes. They assume that working harder, thinking more, and trusting their own judgment is always better than following a system. But in investing, the evidence points clearly in the other direction. Think about a practical application here. If you are an investor who currently makes decisions based on news, gut feelings, tips from friends, or your emotional reaction to seeing a red or green number on your screen, you are very likely leaving significant returns on the table. The first step toward better investing is not finding better stocks. The first step is building a better process, one with rules that you commit to following even when it feels uncomfortable. This does not mean you need a complex computer system to invest well. It means you need clear criteria for what you will buy, how much you will pay, and when you will sell, criteria set in advance and followed consistently. Gray gives us something even more powerful than that, though. He builds a complete model, and in the next chapter, he shows us the full picture of what quantitative value investing can do. But before we move on, remember this. The goal is not to outsmart the market with cleverness. The goal is to outsmart your own emotions with discipline. And discipline, applied consistently over a long time, is the closest thing to a sure thing that investing has to offer. Chapter 4. The Power of Quantitative Value Investing. We have now seen the problem. Human emotions destroy investment returns. We have seen the solution. A rules-based, systematic approach removes emotion from the equation. And we have seen the evidence. Value strategies beat the market over long periods of time. Now, it is time to put it all together. Chapter 4 is where Wesley Gray introduces the full concept of quantitative value investing, and it is where this book begins to feel genuinely exciting for any investor serious about building long-term wealth. Let us start with a clear picture of what quantitative value investing actually means. The word quantitative simply means number-based or systematic. It means using data and rules rather than opinion and feeling. The word value means looking for businesses that are selling for less than they are actually worth. Put these two things together and you have a system that searches the entire stock market for genuinely cheap, genuinely sound businesses using consistent criteria without emotion. This is enormously different from how most investors operate. Most investors either follow a gut feeling, or they follow the crowd, or they listen to analysts who themselves are subject to the same behavioral biases we discussed in the last chapter. The quantitative value investor follows a tested process, and because the process is tested, he knows in advance what kinds of returns it has delivered historically and what kinds of drawdowns he should expect when things temporarily go against him. This knowledge is incredibly valuable. Here is why. When a strategy goes through a difficult period, and all strategies do, the investor who understands the strategy deeply is far more likely to stay the course. He knows that a period of underperformance is not a signal to abandon the approach. He knows it is a temporary situation that historically resolves in favor of the patient, disciplined investor. Think of it like this. Imagine a farmer who plants wheat every year. Some years the harvest is great. Some years there is drought. The farmer does not stop planting wheat after a drought year. He knows the long-term pattern. He knows that patient, consistent farming over decades builds a prosperous farm. He does not panic and switch to growing something else every time one season disappoints him. The quantitative value investor is that farmer. Now, what makes this approach particularly powerful is the combination of two things that on the surface might seem contradictory. The first is the scientific precision of a tested, data-driven system. The second is the timeless wisdom of fundamental value investing, of finding real businesses selling at genuine discounts. Most quantitative investors use purely mechanical systems without much thought about what the numbers actually represent. Most value investors rely too heavily on judgment and not enough on systematic rules. Gray and Carlisle combine both, and the result is something more powerful than either approach alone. Here is a real-world illustration. Think about a highly skilled doctor. He has deep knowledge of medicine, years of clinical experience, and genuine care for his patients. But when he needs to make a diagnosis, he also uses medical tests, lab results, imaging, and established protocols. He does not rely on intuition alone. He combines his judgment with data and systematic processes. This is exactly what quantitative value investing does for the investor. It takes the wisdom of great investors like Graham and Buffett, turns it into a testable, systematic process, and applies it with scientific rigor across the entire stock market. The power of this approach can be seen in long-term performance data. Portfolios of stocks selected using quantitative value criteria have, over decades of historical data, significantly outperformed the market average. And they have done so not just occasionally but consistently, across different market cycles, different economic conditions, and different geographic markets. But here is the important nuance, and this is where many investors miss the point. The outperformance does not come in a straight line. There are periods, sometimes lasting 2 or 3 years, where a quantitative value approach underperforms. During these periods, investors who do not deeply understand the strategy will abandon it and chase whatever is currently working. This is precisely why the approach continues to work. If quantitative value investing were easy and comfortable, everyone would do it. The returns would be competed away. The fact that it requires discipline through uncomfortable periods is part of what makes the returns available in the first place. This is why this matters in real investing. The edge in this strategy is not just in the numbers. The edge is in the willingness to stay disciplined when everyone else is running away. Practical application for you. If you are thinking about adopting any systematic investment approach, start by honestly assessing your own patience. Before you commit any money, ask yourself, can I follow this system for 5 years, even during the 2 years when it seems to be failing? If you can honestly say yes, You are ready to begin building the kind of long-term wealth that quantitative value investing can deliver. Now we have our foundation. We understand the problem, the solution, and the power of the approach. But knowing that we want to buy cheap quality businesses is just the beginning. Before we can buy anything, we need to make sure we are not buying a business that is about to collapse, one that has hidden problems buried in its financial statements, or one that is already teetering on the edge of bankruptcy. This is where part 2 begins. And it starts with one of the most important and underappreciated skills in all of investing: the ability to protect yourself from permanent loss. Chapter 5. Financial Statement Manipulation. Every business that trades on a public stock market is required to publish financial statements, documents that tell the world how much money the company made, how much it owns, how much it owes, and how its cash flows in and out. These statements are supposed to be honest. They are not always honest. This is not just a theory. The history of public markets is littered with companies that presented financial statements showing strong profits and healthy growth, right up until the moment they collapsed entirely, leaving investors with worthless stock and devastating losses. Enron, WorldCom, Theranos. These are just a few famous examples. But for every famous case, there are hundreds of smaller, less publicized examples of companies that quietly manipulated their numbers for years before the truth eventually came out. Wesley Gray dedicates an entire chapter to this topic because it is one of the most critical steps in building a sound quantitative value strategy. Before you can look for a bargain, you must make absolutely sure the business you are looking at is not built on fiction. Here is how financial manipulation typically works. Companies have significant flexibility in how they report their earnings. The rules of accounting, while they provide structure, also leave room for judgment. Managers can choose to recognize revenue earlier or later, to expense certain costs in different periods, to capitalize spending that might otherwise be treated as an immediate cost, and to use estimates for items like bad debt and depreciation in ways that favor a more flattering picture. When managers use this flexibility aggressively to make results look better than they truly are, they are engaging in what is politely called earnings management and what is less politely called manipulation. Now, here is the important question for an investor. How do you spot it? Gray draws on the work of several academic researchers who developed models to detect financial manipulation. The most famous of these is the work of Mesud Benesh, who created what is known as the Benesh M-score, a formula that uses 8 different financial ratios to produce a score indicating whether a company's financial statements are likely to have been manipulated. The model looks at things like how receivables are growing relative to sales, how margins are changing, how much debt is on the balance sheet, and how the overall quality of assets is shifting over time. When these factors move in certain directions simultaneously, it is a strong signal that management may be managing the numbers rather than honestly reporting them. Think about a real-world example. Imagine a small manufacturing company. Its sales are growing quickly. Its reported profits are rising. Investors are excited. But if you look closely, you notice that the money customers owe the company, what accountants call receivables, is growing much faster than sales. This means customers are buying more but paying more slowly. One possibility is that the company is genuinely growing. Another possibility is that the company is booking sales before they are truly earned, effectively borrowing future revenue and presenting it today to make results look better. This difference matters enormously. If the first is true, the company is a bargain. If the second is true, the company is a trap. A quantitative model that checks these signals systematically will flag the second company, removing it from consideration before any money is placed at risk. This is where most beginners make mistakes. They look at the headline numbers, the revenue growth, the rising earnings per share, and they feel good about the investment. They do not go deeper. They do not ask whether those numbers are clean. Gray's approach builds this skepticism directly into the model. Every candidate company is screened for signs of manipulation before any further analysis is done. Here is a practical application. If you are evaluating any investment today, before you look at how cheap the stock is or how quickly the business is growing, take a step back and ask whether you trust the numbers you are looking at. Look for signs that revenues and expenses are being managed in ways that appear too convenient. If profits are rising but cash flow from operations is not keeping pace, That is a warning sign worth taking seriously. Cash is harder to fake than earnings. When a company reports strong profits but consistently weak cash generation, something deserves deeper examination. Now, even a company with clean, honest financial statements can still destroy your capital if it is about to go bankrupt. The manipulation screen protects you from dishonest companies. But there is a separate and equally important screen that protects you from financially fragile companies. That is the subject of the next chapter. And in many ways, it is even more urgent because financial distress can strike even businesses with perfectly honest accounting. Chapter 6. Financial Distress and Bankruptcy Risk. Here is one of the cruelest experiences an investor can have. You find a stock that looks extraordinarily cheap. Everything about the valuation says this is a bargain. You buy it. Then 6 months later, the company files for bankruptcy. The stock goes to zero. Everything you invested is gone. This is called a value trap, and it is one of the most painful experiences in investing. It happens because cheap is not always cheap for the right reasons. Sometimes a stock is cheap because the market sees something that a quick glance at the numbers does not reveal. Sometimes a business is cheap because it genuinely cannot survive. Wesley Gray dedicates Chapter 6 to the critically important topic of assessing financial distress and bankruptcy risk, and he draws on decades of academic research to build a systematic approach to avoiding companies that are on the road to financial ruin. The key insight here is elegant. You are not trying to buy cheap stocks. You are trying to buy stocks that are cheap relative to what they are worth, and that have a reasonable probability of surviving long enough to realize that value. A business trading at a very low price because it is about to go bankrupt is not a bargain. It is a loss waiting to happen. Gray references two important models in this chapter. The first is the Altman Z-score, developed by Edward Altman in the 1960s and still widely used today. The Z-score uses several financial ratios, including measures of profitability, leverage, liquidity, and activity, to produce a single number that indicates how close a company is to financial distress. Companies with low Z-scores are in the danger zone. Companies with high Z-scores are on solid financial ground. The second model is the Olson O-score, a later development that uses a different set of variables and a statistical approach to estimate the probability that a company will go bankrupt within the next 2 years. Both models serve the same basic purpose. They allow an investor to quickly assess whether a company that appears cheap is cheap because of a genuine temporary setback, or cheap because it is in genuine danger of failure. Think about a real-world scenario. Imagine two retail companies. Both have seen their stock prices fall significantly over the past year. Both look cheap by simple valuation measures, but one has a strong balance sheet, manageable debt, and positive cash flow. The other has high debt, shrinking sales, and is burning through its cash reserves quickly. The first company is a potential value opportunity. The second is a potential bankruptcy waiting to happen. Without a systematic screen for financial distress, an investor might buy both and hope for the best. With a proper distress model, the second company is removed from consideration before any capital is put at risk. This is where this matters deeply in real investing. The single biggest enemy of wealth building in the stock market is not missing a great opportunity. It is experiencing a permanent loss of capital. A stock that falls 50 units and then recovers is manageable. A stock that goes to zero and never recovers is devastating, not just financially but psychologically, in ways that affect future decision-making for years. Protecting yourself from permanent loss is the first and most fundamental job of a serious investor. Here is an important psychological insight. Many investors are drawn to deeply distressed companies precisely because they look so cheap. The lower the price, the more compelling the apparent bargain. This is a dangerous trap. The companies that look most dramatically cheap are often the ones most likely to go bankrupt because the market has already been discounting the risk of failure into the price. A well-designed quantitative model removes this temptation. It systematically excludes companies with high bankruptcy risk, even when they look attractively priced. This keeps you safe from the seductive but deadly value trap. Practical application. Before you invest in any company that has seen a significant price decline, Ask yourself whether the decline is due to a temporary problem or a structural threat to the business's survival. Look at the balance sheet. Is the company generating cash or burning through it? Is the debt level manageable or overwhelming? Does the company have enough financial flexibility to survive a rough patch? If the answers raise serious doubts, move on. There are always other opportunities. There is no opportunity in a stock that eventually goes to zero. Now you have built the defensive wall. You know how to avoid companies with manipulated financial statements. You know how to avoid companies at genuine risk of bankruptcy. You have protected yourself from permanent loss, but avoiding disaster is only half the job. The other half is finding excellence. And that is what Part 3 is all about. We are moving from defense to offense. We are moving from avoiding the worst to finding the best. Chapter 7. The Economic Franchise. Think about the businesses you encounter every day. Some of them have something special, something that makes them almost impossible to compete with. Something that keeps customers coming back year after year, even if the price goes up a little. Something that allows them to earn more money than the average business without constantly having to fight off competitors. This something is what Warren Buffett calls a moat. In the language of this book, it is called an economic franchise. And it is one of the most important things a quantitative value investor looks for. Understanding what makes an economic franchise is not complicated, but it is profoundly important. A business with an economic franchise has a durable competitive advantage. It can protect its profits over time. It can raise prices without losing customers. It can earn returns on its capital that exceed what it costs to employ that capital. And it can do all of this for years, sometimes decades, without being successfully challenged by competitors. These businesses are rare. And when you find them trading at cheap prices, you have found something genuinely special. Let us walk through the different types of economic franchises that Gray describes. The first is a brand advantage. Think of a company whose products people trust and return to again and again, not because the product is rationally superior in every technical sense, but because the brand represents something, a feeling, a quality, a promise. Customers pay a small premium for this brand, willingly, because the brand reduces their decision-making effort and gives them confidence. This kind of advantage is extraordinarily hard to replicate. A competitor can copy the product, but copying decades of brand trust is nearly impossible. The second type of franchise is a switching cost advantage. Some businesses build themselves so deeply into their customers' operations that leaving becomes extremely expensive. Software companies are a classic example. Once a large business has built its entire workflow around a specific software system, the cost of switching to a different system, in time, money, staff retraining, and risk, is enormous. This keeps customers loyal even when competitors offer slightly better products at lower prices. The third type is a network effects advantage. Some businesses become more valuable as more people use them. The classic example is a telephone network. A phone that connects to 1 million people is far more valuable than a phone that connects to 10,000. As the network grows, each additional member makes the entire network more valuable to everyone. This creates a powerful self-reinforcing cycle that makes it very difficult for new competitors to start from scratch and challenge an established player. The fourth type is a cost advantage. Some businesses have found ways to produce their goods or services at significantly lower cost than any competitor. This might come from access to unique raw materials, proprietary technology, a superior supply chain, or simply enormous scale. A business that can make something cheaper than anyone else has a powerful and durable advantage. Think about a real-world example. Consider a small regional airline versus a large established one. The large airline has massive scale, better relationships with aircraft manufacturers, lower per-seat fuel costs because of fleet size, and a known brand that travelers trust. A new competitor trying to enter the same market faces enormous disadvantages from the very beginning. This is what an economic franchise looks like in practice. Now, here is the critical question for the quantitative value investor. How do you measure a franchise systematically without relying on subjective judgment? Gray uses financial metrics that reflect the underlying reality of a strong business. He looks at return on invested capital, which measures how much profit a business generates for every unit of capital employed. A business with a consistently high return on invested capital is almost by definition earning above-average profits relative to what it costs to operate, which is a strong quantitative signal of an economic franchise. He also looks at consistency. A business that earned extraordinary returns 5 years ago but mediocre returns today may have lost its franchise. A business that earns consistently strong returns across multiple years and different economic conditions has demonstrated the durability that defines a true franchise. This is where most beginners make mistakes. They look for businesses that had one great year recently and assume the franchise is strong. A genuine franchise reveals itself through consistency across time, not brilliance in a single year. Here is a deeper insight. The most powerful investment returns come from businesses that combine two things that almost never appear together. They are both cheap and excellent. A cheap business with a weak franchise might generate modest returns as its price recovers toward fair value, but then it stalls. A cheap business with a genuine franchise can compound returns for years because as the price recovers, the underlying business keeps growing. This combination, cheap price plus genuine franchise, is the holy grail of quantitative value investing. Practical application. The next time you look at any business as a potential investment, ask these questions. Does this company have something that genuinely protects it from competition? Have its returns on capital been consistently above average over the past 5 to 10 years? Could a well-funded competitor easily replicate what this business does? If the answers suggest a genuine franchise, you are looking at a business worth studying further. Now you understand what makes a great business great from the inside. But the best business in the world can still be a poor investment if it is buried under mountains of debt or if its financial structure leaves it vulnerable to economic downturns. This brings us to the companion chapter on financial strength. Chapter 8. Financial strength. A business can have a beautiful brand, loyal customers, and rising profits. But if it has borrowed too much money, if its liabilities exceed its ability to service them, even a temporary economic storm can destroy it entirely. Financial strength is the immune system of a business. When times are good, you barely notice it. When times are tough, it is the difference between survival and catastrophe. Wesley Gray dedicates Chapter 8 to understanding how to assess the financial strength of a business in a systematic, quantitative way. Let us start with the most fundamental measure of financial strength: cash flow. Cash is the lifeblood of any business. Not reported earnings, not accounting profits, but actual cash flowing in and out of the business. A business that consistently generates more cash than it spends is inherently strong. A business that consistently spends more cash than it generates must eventually go to creditors or shareholders to fill the gap, which creates dependency and vulnerability. Gray emphasizes free cash flow, which is roughly the cash a business generates from its operations after spending what is necessary to maintain and grow its asset base. Businesses with consistently high free cash flow have genuine financial strength. They can weather economic storms, invest in growth opportunities, return money to shareholders, and operate with the kind of flexibility that makes long-term success possible. The second major dimension of financial strength is the balance sheet. A balance sheet shows what a business owns on one side and what it owes on the other. The difference between these two is the net worth of the business, what belongs to the shareholders. Businesses with strong balance sheets have more assets than liabilities, manageable debt levels, and significant equity cushion. They can absorb shocks. They have the financial flexibility to act during crises when assets are cheap and competitors are struggling, rather than simply trying to survive. Businesses with weak balance sheets are leveraged. They have borrowed heavily to grow or to meet obligations. In good times, the leverage amplifies their returns. In bad times, the leverage amplifies their losses. And in the worst times, the leverage kills them. Think about a real-world scenario. Imagine two property development companies in the run-up to a real estate downturn. Company A has borrowed heavily to buy and develop properties, betting that prices will keep rising. Company B has used more equity and less debt, building more slowly but on a stronger financial foundation. When the market turns, Company A cannot service its debt. It is forced to sell assets at distressed prices, which destroys its equity. It may not survive. Company B slows down, waits for the storm to pass, and then buys assets cheaply from companies like Company A that are forced to sell. This is the real-world power of financial strength. Gray also looks at the Piotrowski F-score, a tool developed by accounting professor Joseph Piotrowski, which scores companies on 9 different financial criteria related to profitability, leverage, liquidity, and operational efficiency. Each criterion produces a single point if the company passes. A score of 9 means the company passes all 9 tests. A score of 1 or 2 means it fails almost all of them. Studies have shown that companies with high Piotrowski F scores significantly outperform companies with low F scores, particularly among cheap value stocks. This makes the F score a powerful tool for separating strong, improving businesses from weak, deteriorating ones within the universe of cheap stocks. Here is the key insight. Among cheap stocks, not all are created equal. Some are cheap because they are genuinely improving, getting stronger, generating more cash, reducing debt. Others are cheap because they are genuinely deteriorating, getting weaker, burning cash, taking on more debt. The Piotrowski F score helps separate these two groups, and buying the improving group while avoiding the deteriorating group significantly improves investment returns. This is where most beginners make mistakes. They treat all cheap stocks as equivalent. They assume that cheap means good and expensive means bad. But within the world of cheap stocks, the financially strong ones dramatically outperform the financially weak ones. Selecting only strong, cheap businesses is far more powerful than simply buying all cheap businesses. Practical application. If you are building any kind of value-focused portfolio, do not just screen for cheap stocks. Add a layer that checks financial strength. Look for businesses with positive cash flow, manageable debt, and evidence of improving financial health. These extra steps significantly reduce risk while improving expected returns. Now we have the defensive and quality layers in place. We know how to avoid manipulated financials. We know how to avoid bankruptcy-prone companies. We know how to identify businesses with genuine competitive advantages. We know how to assess financial strength. What we have not done yet is the thing most people think investing is entirely about: finding the bargain price. And the way Gray approaches this, drawing on decades of academic research and a healthy dose of skepticism toward conventional wisdom, is genuinely fascinating. Chapter 9. The Secret to Finding Bargain Prices. Ask 10 investors how they measure whether a stock is cheap, and at least 8 of them will give you the same answer. The price-to-earnings ratio. It is the most widely used valuation measure in the world. It is quoted in every financial newspaper, every analyst report, every investment app, and it is, according to Gray's research, far from the best measure of value. This chapter is where the book gets particularly interesting, because Gray is not just telling you how to find cheap stocks. He is showing you that the conventional wisdom about measuring cheapness is deeply flawed, and that better measures exist that most investors have never heard of. Let us start by understanding why the price-to-earnings ratio, while useful and intuitive, has serious limitations. The price-to-earnings ratio compares the price of a stock to the earnings the company reports. The idea is that a lower ratio means you are paying less for each unit of profit, which makes it a bargain. The problem is that earnings can be manipulated. As we saw in Chapter 5, companies have enormous flexibility in how they report their earnings. A company can legally adjust its reported earnings using accounting choices that do not reflect the true economic reality of the business. This means that a company with a low price-to-earnings ratio might look cheap, but if its earnings are inflated through aggressive accounting, the true ratio is much higher, and the apparent bargain is actually an illusion. A better measure, Gray argues, is one that uses earnings numbers that are harder to manipulate. Operating earnings before taxes, amortization, and depreciation tend to reflect the underlying economics of a business more faithfully than the final net earnings number that appears at the bottom of an income statement. These numbers are harder to dress up through accounting choices. But the most powerful measure Gray highlights is something called the enterprise multiple, sometimes called the enterprise value to EBITDA ratio. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The enterprise multiple compares the total cost of acquiring a business, including its debt, to the operating earnings the business generates before financing and accounting adjustments. The reason this measure is more powerful than a simple price-to-earnings ratio is that it looks at the whole picture of what you are buying. When you buy a stock, you are not just buying the equity. You are taking on responsibility for the entire capital structure, including the debt. A company that looks cheap by its equity price might be very expensive once you account for the debt you are also taking on. Think about a real-world example. Imagine two houses for sale in the same neighborhood. House A has a price tag of 100,000 units of currency and no mortgage. House B has a price tag of 70,000 units of currency but has an existing mortgage of 60,000 units that the buyer must take over. Which is cheaper? If you only look at the price tags, House B looks dramatically cheaper. But when you account for the debt, House A is actually the better deal. The enterprise multiple is the investing equivalent of accounting for that mortgage. Gray's research, drawing on academic studies going back decades, shows that stocks selected based on the enterprise multiple have significantly and consistently outperformed stocks selected based on the price-to-earnings ratio, the price-to-book ratio, and most other commonly used valuation measures. This is a genuinely important finding. Think about how many sophisticated investors are using price-to-earnings ratios as their primary valuation tool, while a better tool is available and has been available in the academic literature for decades. This gap between academic knowledge and common practice is exactly the kind of inefficiency that a disciplined quantitative value investor can exploit. Now, here is a deeper insight that goes beyond just the choice of valuation metric. The reason valuation metrics work at all is because markets are driven by human emotion. When times are bad for a particular industry or company, investors overreact, selling too aggressively and pushing prices below fair value. When times are good, investors overreact in the other direction. A systematic approach that consistently buys what is cheap and avoids what is expensive is effectively harvesting the mispricing that human emotion creates. As long as humans remain emotional, and they will always remain emotional, this approach will continue to produce above-average returns. This is why this matters in real investing. The single most important quantitative decision you will ever make as a value investor is choosing the right measure of cheapness. Not all measures are equal, not all cheap stocks are truly cheap, and the difference between a mediocre valuation metric and a great one can translate into significant differences in long-term investment returns. Practical application. If you are currently using price-to-earnings as your primary valuation metric, begin supplementing it with measures that look at the total cost of acquiring a business relative to its total earnings power. Ask not just what the stock costs, but what the entire business costs, including the debt. And use earnings measures that are harder to manipulate than the final reported net income number. We now have a powerful primary valuation tool. But Gray goes further. He knows that no single metric tells the complete story, and that the best results come from combining multiple measures in a thoughtful way. Chapter 10. Advanced Value Metrics and Composite Measures. A single number is never the whole truth about a business. This is one of the most important lessons any investor can learn, and it is the central theme of Chapter 10. The enterprise multiple we discussed in the last chapter is powerful, but it is one lens. Gray argues that the most robust, reliable approach to identifying genuine bargain stocks is to use multiple valuation measures simultaneously, each capturing a slightly different dimension of cheapness. When several different measures all agree that a stock is cheap, the signal is far stronger than when only one measure says so. When several measures agree, it is more likely that the cheapness is real, not an artifact of one particular accounting convention or one particular market situation. Think about how a doctor diagnoses a serious illness. A single symptom is suggestive but inconclusive. Two symptoms narrow the possibilities. 3 or 4 symptoms pointing in the same direction make the diagnosis far more confident. The same logic applies to identifying undervalued stocks. Gray introduces several measures that complement the enterprise multiple. The first is the price-to-book ratio. This measure compares the stock price to the book value of the business, which is essentially the accounting value of the assets minus the liabilities. Benjamin Graham used this measure extensively, and research has consistently shown that cheap by-book value stocks outperform expensive by-book value stocks over long periods. The limitation is that book value can be significantly distorted by accounting conventions, particularly for businesses with many intangible assets like brands and patents, which often do not appear on the balance sheet at anything close to their true economic value. The second is the price-to-free cash flow ratio. This compares the stock price to the actual cash the business generates for its owners after maintenance and growth investments. Free cash flow is arguably the most honest measure of what a business is truly worth to its owners, because cash is genuinely harder to manipulate than accounting earnings. A stock that is cheap relative to its free cash flow is one where the market appears to be paying too little for the actual cash the business produces. This is a compelling signal. The third is the earnings yield. This is simply the inverse of the price-to-earnings ratio. Instead of asking how many units of price you pay for 1 unit of earnings, it asks what proportion of the price you pay is returned to you as earnings. A high earnings yield means more earnings per unit of price, which is the definition of cheapness. Joel Greenblatt, one of the most successful value investors of his era, used earnings yield as half of his famous magic formula, combining it with return on capital to create a simple but powerful stock selection system. Gray builds on this work and goes further. Now here is where the chapter becomes particularly interesting for a serious investor. Gray tests these individual measures carefully, but he does not stop there. He asks whether combining multiple measures into a single composite score produces better results than any individual measure alone. The answer is yes, and the improvement is significant. A composite value score that takes into account several different valuation metrics simultaneously does a better job of identifying genuinely cheap stocks than any single metric can do on its own. This is because different metrics capture different aspects of cheapness, and a stock that is cheap on multiple dimensions simultaneously is more likely to represent a genuine bargain than one that is cheap on only one dimension. Think about this in everyday terms. Imagine you are evaluating a used car for purchase. You might look at the asking price relative to similar cars, the mileage, the service history, the condition of the body, and the mechanical inspection report. A car that looks good on only one of these dimensions might be a reasonable buy. A car that looks good on all 5 simultaneously is almost certainly a genuine bargain. The composite value approach applies exactly this logic to stock selection. This is where most beginners make mistakes. They find one valuation metric that seems to work, apply it in isolation, and conclude they have a solid investment process. The more sophisticated approach is to check multiple measures and to look for situations where multiple measures simultaneously signal genuine cheapness. This is an important psychological point too. Using a composite measure helps protect against the confirmation bias we discussed earlier. If you have already decided you like a company, a single valuation metric is easy to rationalize away. But when 5 different valuation metrics all say a stock is expensive, it is much harder to convince yourself it is actually cheap. Now, here is a practical bridge forward. You have built a robust framework for finding quality businesses at bargain prices, but the story does not end there. The stock market is full of signals beyond valuation that can help identify which cheap stocks are most likely to outperform and which are most likely to disappoint. These signals are what Part 5 is all about. They are not primary valuation tools. They are confirming signals. They are the additional data points that, when they align with a strong valuation case, make the overall investment thesis significantly more compelling. Chapter 11. Share Repurchases. When a company buys back its own shares, it is doing something that might seem straightforward at first glance, reducing the number of shares outstanding, which means each remaining share represents a larger piece of the business. But there is a much deeper story here. Share repurchases are one of the most powerful signals available to an investor, not just because of the mechanical effect on per-share value, but because of what they reveal about what management believes about the company's own stock. Think about it this way. A company has a choice about what to do with its spare cash. It can invest in new projects, acquire other businesses, pay dividends to shareholders, or buy back its own shares. When it chooses to buy back shares, it is implicitly saying something very specific. It is saying, we believe our own shares are worth more than the current market price. No management team is going to voluntarily spend the company's money buying something they think is overpriced. When they buy back shares, they are, in effect, betting the company's own capital that the market is undervaluing the stock. This is insider knowledge applied at a capital allocation level. Now, like all signals, share repurchases are not uniformly informative. Not all buybacks are equal. There are important distinctions. The first distinction is between genuine buybacks and window dressing. Some companies buy back shares primarily to offset the shares they issue to employees through stock options and compensation plans. This is not a real reduction in share count at all. It is simply running on a treadmill, buying shares on one hand while issuing them on the other. These kinds of buybacks have very little predictive value. The second distinction is between buybacks at reasonable prices and buybacks at inflated prices. Some management teams, particularly during periods of corporate optimism, buy back shares at peak prices, effectively destroying shareholder value by paying too much for the company's own stock. These buybacks actually hurt long-term investors, even though they are executed with the best intentions. The buybacks that matter are genuine reductions in share count at prices that appear reasonable or cheap. When a company is buying back its own shares aggressively, and those shares also score well on the valuation measures we discussed earlier, this combination is particularly compelling. Think about a real-world example. Imagine a well-managed industrial company that has been consistently profitable for many years. Its stock has fallen due to general market pessimism about the industrial sector, not because of anything specific to the company's operations. Management looks at the current price and decides, this is an extraordinary opportunity. They accelerate their buyback program, buying a significant number of shares at what they believe are deeply discounted prices. This is a powerful corroborating signal. The market is selling. Management, who knows the business better than anyone, is buying. This is where most beginners make mistakes. They see a falling stock price and interpret management buying as confirmation of the problem rather than evidence of opportunity. The key is to use buybacks as one signal among several, and to give it the most weight when it coincides with other positive quantitative signals. Here is an important psychological angle. Most investors are not watching share repurchase activity closely. It is disclosed in regulatory filings, but it requires effort to track. This is precisely why it contains information. If every investor were actively tracking buybacks, the signal would be competed away. The fact that most investors ignore this data is what gives it value. Practical application. When you have identified a stock that scores well on valuation and quality measures, check whether the company has been actively reducing its share count. If yes, you have additional confirmation that insiders believe the stock is cheap. If no, or if the share count is actually growing through new issuances, this is a cautionary note worth considering. Now, buybacks tell you what management is doing with company money. But the even more direct signal is what management does with their own personal money. When executives and board members are buying shares with their own savings, that is the most direct signal of insider confidence that exists. Chapter 12. Insider buying and selling. Imagine you are considering buying a house in a specific neighborhood. You have already analyzed the property, the price seems reasonable, the structure looks sound. Then you find out something interesting. The town mayor, who lives in the neighborhood, the chief of police, the school principal, and the head of the local hospital board have all quietly been buying houses on the same street in the past few months, using their own personal savings. Would this influence your decision? Almost certainly yes. These are people who know more about the neighborhood than almost anyone. Their decision to put their own money into properties there is a powerful signal that they expect the area to appreciate in value. This is precisely the logic behind insider buying as an investment signal. Corporate insiders, meaning executives, directors, and major shareholders, have access to information about their company that no outside investor can fully replicate. They know about upcoming product launches, cost-cutting successes, regulatory approvals, and long-term strategic plans before the public does. When they buy shares of their own company with their personal money, they are putting real financial skin in the game based on this superior knowledge. Gray points out that insider buying is a particularly powerful signal under specific conditions. The most compelling signal comes when multiple insiders are buying simultaneously, not just one, because multiple insiders acting independently of each other suggests a broadly shared conviction that the stock is undervalued. The next most important factor is the size of the purchase relative to the insider's total holdings. An executive who buys a small symbolic amount of shares is sending a much weaker signal than one who makes a significant purchase representing a meaningful portion of their personal wealth. Purchases made in the open market, as opposed to purchases through compensation plans, are significantly more informative because open market purchases require the insider to voluntarily choose to allocate personal money to the company's stock. On the flip side, insider selling is less informative, and for an interesting reason. Insiders sell shares for all kinds of reasons that have nothing to do with their view of the company's value. They might sell to fund a house purchase, pay school fees, diversify their personal wealth, or meet tax obligations. A single insider selling a portion of their holdings does not tell you much, but concentrated, large-scale insider selling across multiple insiders is worth paying attention to. When many insiders are reducing their holdings at the same time, it is worth asking what they might know. Think about a real-world example. Consider a technology company in its mid-size growth phase. Its stock has fallen over the past year after disappointing earnings in one quarter. The chief executive, the chief financial officer, and two board members all independently purchased shares in the open market over the following months, each making purchases that represent significant personal financial commitments. This cluster of insider buying, following a stock price decline, is exactly the kind of signal that strengthens an already compelling valuation case. This is why this matters in real investing. No outside analyst or investor has the information that insiders have. When insiders put their own money on the line, they are speaking louder than any analyst report or research note. Practical application. Insider transaction data is publicly disclosed through regulatory filings in most major markets, and it is available through financial data services. Before making a significant investment in any individual stock, spend a few minutes reviewing recent insider transaction activity. Look for recent open market purchases, particularly when multiple insiders are buying simultaneously. This adds a valuable confirming signal to your investment case. Now we have looked at what management does with company money and what insiders do with their own money. But there is another group of sophisticated market participants whose behavior carries important information. Short sellers. Chapter 13. Short selling signals. Short selling is one of the most misunderstood activities in financial markets. Most people know that short sellers bet on stocks falling in price. They are often portrayed as villains, as speculators trying to destroy companies and profit from the misery of other investors. But here is what most people do not know. Short sellers are, on average, the most carefully researched and analytically sophisticated investors in the market. Think about why. When you buy a stock, the worst that can happen is that it falls to zero and you lose your entire investment. Your loss is limited. When you short sell a stock, your potential loss is theoretically unlimited because there is no ceiling on how high a stock price can rise. A short seller who is wrong does not just lose their investment. They can lose multiples of what they put in. This asymmetry of risk means that short sellers do an enormous amount of due diligence before they bet against a company. They are looking for businesses with serious, fundamental problems, things that will eventually cause the stock price to fall. They research deeply. They analyze carefully. They look for the things that most buyers overlook. This means that when a stock has very high short interest, meaning many investors have taken positions betting it will fall, this is a powerful signal worth taking seriously. Gray argues that heavy short interest in a stock is a warning sign that should cause a value investor to pause, even if the valuation metrics look attractive. Why? Because the sophisticated investors who have shorted the stock may know something that the valuation metrics are not capturing. Perhaps they have identified a fundamental problem with the business model. Perhaps they have found evidence of accounting irregularities. Perhaps they have spotted a competitive threat that is not yet visible in the financial statements. Heavy short interest does not automatically mean a stock is a bad investment. Sometimes short sellers are wrong. In fact, there is a phenomenon called a short squeeze, where a heavily shorted stock rises quickly, forcing short sellers to buy shares to cover their positions, which drives the price up even further. But for a quantitative value investor, heavy short interest is a yellow flag that warrants extra caution. Conversely, low short interest in a stock that otherwise meets all the quality and valuation criteria is a positive confirming signal. It means the most skeptical, most deeply researching investors in the market have not found anything seriously wrong with the business. Think about a practical illustration. Imagine two companies that both score equally well on valuation metrics and financial strength measures. Everything in the quantitative model looks identical. But Company A has very low short interest, while Company B has very high short interest. A careful investor should prefer Company A. The lack of significant short selling suggests that sophisticated investors with short positions, who have the most incentive to find problems, have not found problems compelling enough to bet against the stock. This is where most beginners make mistakes. They dismiss short selling activity as irrelevant or malicious, not seeing it as the valuable information signal that it actually represents. The short sellers are doing research, and their aggregate conclusions are worth incorporating into your investment process. Practical application. When you are building a position in any individual stock, check the short interest data. It is publicly available for exchange-listed stocks. A sudden, sharp increase in short interest on a stock you own is worth investigating. A consistently low short interest across a period of time adds a layer of confirmation to your investment thesis. Now, we have examined signals from management behavior, insider activity, and short sellers. But there is one more important group of market participants whose behavior contains relevant information: institutional investors, the large professional money managers who collectively control enormous amounts of capital. Chapter 14. Institutional Investor Signals. Large institutional investors, including pension funds, insurance companies, sovereign wealth funds, endowments, and large mutual funds, collectively own a significant portion of all publicly traded stocks in major markets. These institutions employ teams of analysts. They have access to management teams. They conduct site visits. They build complex financial models. And their decisions to buy or sell large positions move markets. Understanding what they are doing, and more importantly, what they are not doing, provides valuable information for the individual investor. Gray makes a counterintuitive but important point in this chapter. The best signals from institutional activity often come from what institutions are not doing, specifically from stocks that are largely ignored by institutional investors. Here is the reasoning. When a stock has very high institutional ownership, it means it has been extensively analyzed, widely covered, and broadly owned by sophisticated professional investors. In this situation, all the publicly available information about the stock has likely already been incorporated into the price. The stock is efficiently priced. The chances of finding a genuine bargain are much lower. But when a stock has very low institutional ownership, the situation is different. This might mean that the stock is too small for institutions to bother with, since a large fund buying even a small position in a tiny company would move the price significantly. It might mean the stock is in an industry that institutions currently find unattractive. It might mean it is simply off the radar of most professional analysts. These are exactly the situations where genuinely cheap stocks are most likely to be found. Now, this does not mean that low institutional ownership is itself a positive signal. A stock could be ignored for perfectly good reasons, such as being a genuinely terrible business. But when low institutional ownership coincides with strong valuation metrics, high financial quality, and other positive confirming signals, it adds to the case that the market may have genuinely missed something. On the flip side, a sharp increase in institutional buying of a stock, particularly across multiple different institutions acting independently, can be a positive sign that sophisticated professional investors are recognizing value that the market has not yet fully priced. Think about a real-world scenario. A boring, mid-size industrial company in a sector that has fallen out of favor with investors over the past 2 years. Mutual funds and pension funds have been reducing their positions as they rotate into more fashionable sectors. The stock has fallen to levels where the valuation metrics look genuinely cheap. Short interest is low. Management is buying shares. The financials are clean and the balance sheet is strong. Now, a significant institutional investor, known for its disciplined value approach, begins quietly accumulating a position. This combination of factors tells a very compelling story. This is why this matters in real investing. Individual investors often feel they have no advantage over institutional professionals. But in the world of small and mid-sized company investing, where institutions often cannot participate without disrupting the market, individual investors actually have structural advantages. They can invest in areas that institutions cannot easily reach. Understanding this dynamic and seeking it out deliberately is one of the most powerful edges available to a retail investor with a long-term horizon. Practical application. Before investing, check the institutional ownership percentage of a stock. Look at whether that percentage has been increasing or decreasing over recent quarters. If ownership is low and declining, ask why, and whether the reasons are temporary or structural. If ownership is low but appears to be starting to increase, you may be seeing early evidence of institutional recognition of value. Now we have built up an extraordinary toolkit. We have the defensive screens, the quality measures, the valuation metrics, and the confirming signals. The remaining question is, how do you combine all of these into a single, coherent, testable investment model? This is where the book reaches its most practical and most exciting chapters. Chapter 15 is about how to do this combination wisely. The first and most important principle Gray establishes is the concept of hierarchy. Not all signals are equal. Some are primary, foundational criteria that must be met before a stock can even be considered. Others are secondary, confirming signals that add weight to an already promising case. At the foundation, the model must eliminate companies with manipulated financials and high bankruptcy risk. These are not optional screens. Any company that fails these tests is removed from consideration entirely, regardless of how attractive it looks on other dimensions. This is the defensive layer that protects against permanent loss. The second layer is quality. Among the companies that pass the defensive screen, the model assigns scores based on economic franchise strength and financial strength. Companies with genuinely strong business fundamentals receive higher priority. The third layer is valuation. Among the companies that pass both the defensive and quality screens, the model ranks them based on their composite valuation score, using the enterprise multiple and other metrics we discussed. The fourth layer, the confirming signals, is used to break ties and to add confidence. When a company has a strong valuation case, passes all the quality screens, and also shows favorable signals from share repurchases, insider buying, low short interest, and appropriate institutional dynamics, the combined case is significantly stronger than any individual factor alone. Think about this model as a funnel. At the top of the funnel, you start with the entire universe of investable stocks, potentially thousands of companies. The first filter removes companies with suspicious financial statements. The second filter removes companies with high bankruptcy risk. The third filter scores remaining companies on quality. The fourth filter scores them on valuation. The fifth layer applies confirming signals. What comes out of the bottom of the funnel is a relatively small list of companies that are financially clean, financially sound, genuinely high quality, genuinely cheap, and receiving positive confirming signals from sophisticated market participants. These are the companies worth owning. Here is the critical insight about combining signals. The reason combination works better than any individual signal alone is a concept called diversification of information sources. Just as holding multiple stocks in a portfolio reduces the risk from any single bad outcome, drawing on multiple independent signals reduces the risk that any single bad signal leads you into a bad investment. When you rely on only one metric, whether it is price to earnings or short interest or insider buying, you are exposed to the specific failures of that metric. Some metrics work better in some market conditions than others. Some can be gamed by sophisticated companies and managers. Some simply reflect factors unique to a particular industry. But when multiple independent signals all point in the same direction, the probability that all of them are simultaneously wrong in the same way is much lower. This is why this matters in real investing. The investor who combines multiple signals with a clear hierarchy is not just finding better stocks, they are building a more robust process, one that is less likely to be fooled by any single piece of misleading information. Think about a real-world illustration. A stock looks cheap by the enterprise multiple. You check the Piotrowski F score and it scores highly. Short interest is minimal. Management has been buying shares. The institutional ownership is low but quietly increasing. The business has generated consistently high returns on invested capital over the past decade. Every single signal is pointing in the same direction. This kind of convergence does not happen by accident. When everything lines up, you have found a genuinely exceptional opportunity. These opportunities do not appear every day. But in a universe of thousands of stocks, a properly designed model will find them regularly enough to build a portfolio of 20 to 30 such positions, providing diversification while maintaining the concentrated quality that drives outperformance. Now that we understand how to combine signals, we are ready for the most technical and most powerful chapter in the entire book: the construction of the actual quantitative value model. Chapter 16. Building the Quantitative Value Model. This is the chapter where everything comes together. We are no longer talking about principles or concepts. We are talking about building a real, testable, implementable investment model that any serious investor can study and apply. Wesley Gray walks through the complete architecture of the quantitative value model, explaining each component, the rationale behind every design choice, and how the individual pieces fit together to create something greater than the sum of its parts. Let us walk through the model construction systematically. The first step is defining the investment universe. The model begins by defining which stocks are eligible for consideration. This typically means all publicly traded stocks above a certain minimum market capitalization, which serves to exclude the very smallest and most illiquid companies where trading costs and practical difficulties of building positions would significantly erode returns. The minimum size also excludes many companies where financial data quality is lower and where the bankruptcy and manipulation risks are highest. By focusing on stocks of a minimum meaningful size, the model improves both data quality and practical investability. The second step is applying the exclusion screens. Any company that fails the financial manipulation screen is removed. Any company that scores in the high-risk zone of the Beneish M score is excluded. Any company with a low Altman Z-score or high Olson O-score, suggesting significant bankruptcy risk, is excluded. This dramatically reduces the investable universe, typically removing a significant portion of all available stocks from consideration. The third step is scoring and ranking on valuation. The remaining companies are scored using the composite valuation metrics, with the enterprise multiple playing the primary role. Each company receives a percentile ranking based on its valuation score, where a higher percentile rank means a cheaper, more attractively valued stock. The fourth step is scoring and ranking on quality. The same companies are scored on quality factors, including economic franchise strength as measured by return on invested capital and its consistency, and financial strength as measured by the Piotrowski F score and free cash flow generation. The fifth step is combining the valuation and quality scores. Gray assigns specific weights to the valuation and quality components based on his research findings about which combination has historically produced the best risk-adjusted returns. The combined score produces a final ranking of all eligible stocks from most to least attractive. The sixth step is incorporating the confirming signals. Among the top-ranked stocks from the combined score, the model looks at insider buying activity, share repurchase trends, short interest levels, and institutional ownership dynamics. These signals do not override the primary ranking, but serve to add confidence to the highest-ranked opportunities and to flag potential concerns. The seventh and final step is portfolio construction. The model selects a diversified portfolio of the highest-ranked stocks, typically between 20 and 40 positions, with position sizes determined by confidence level and risk management considerations. The model also defines a rebalancing schedule, typically annually, where the portfolio is reviewed and updated based on the current rankings. Stocks that have fallen out of the top tier are replaced by newly qualified candidates. Stocks that remain in the top tier are held. Think about a real-world parallel. Imagine you are running a scouting team for a professional sports organization. You have developed a comprehensive scoring system that evaluates athletes on athleticism, skill, psychological profile, work ethic, team fit, and contract terms. You do not rely on the eye test alone. You do not pick players based on reputation or narrative. You score every candidate systematically, combine the scores according to weights you have tested over years, and select the best-ranked candidates for your team. Then at the end of each season, you review your roster. Players who no longer meet your criteria are replaced. New candidates who have risen to the top of your rankings are added. This is exactly how the quantitative value model operates. This is where most beginners make mistakes. They build a model with great intentions and then override it with judgment at the critical moment. They read a negative news story about a top-ranked stock and decide to skip it. They read a positive story about a stock that does not qualify and decide to make an exception. Every exception chips away at the model's power. The entire point of a systematic model is to remove these judgment calls, especially in moments of fear and excitement where judgment is most likely to be wrong. Here is an important psychological insight. Following a systematic model is psychologically one of the hardest things an investor can do. It requires trusting a process over your own intuition. It requires buying stocks that feel uncomfortable and avoiding stocks that feel exciting. It requires maintaining discipline through periods when the model appears to be underperforming. This is not natural. It requires deliberate, conscious commitment to a process you have thoroughly understood and deeply believe in. This is why spending time deeply understanding why each component of the model works, as we have done throughout this audiobook, is so valuable. When you understand the reasoning, holding the discipline becomes significantly easier. Practical application. If you are a serious individual investor, begin by understanding each component of a systematic model before you implement any part of it. Do not rush. Study the history of each measure. Understand what it captures and what its limitations are. When you implement the model, document your rules clearly and commit to following them. Track your portfolio decisions against the model's recommendations, and when you deviate, note why and track the outcomes. Over time, you will develop a deeply evidence-based understanding of your own investment process. Now we have the model. But how do we know it works? The answer is backtesting, and this is where the book delivers its final, powerful punch. Chapter 17: Backtesting and Performance Analysis. Every investment strategy sounds compelling in theory. The test of whether a strategy actually works is whether it has delivered superior returns across extended periods of real market history. This is what Chapter 17 is about. Wesley Gray and his team conducted extensive backtesting of the quantitative value model, applying its rules to decades of historical stock market data to see how it would have performed. Backtesting is the process of going back through historical data and applying a set of investment rules as if you had been following them in real time, to measure what kind of results those rules would have produced. This is not a perfect predictor of the future. Markets change. Economic conditions evolve. But a strategy that has worked consistently across multiple different market cycles, different economic regimes, and different geographic markets is significantly more credible than one that has only worked in a limited historical window. The results of the backtesting in this book are striking. The quantitative value model, as Gray and Carlisle constructed it, significantly outperformed the broader market over the periods tested. More importantly, it outperformed not just by a little but by a meaningful margin, and did so consistently enough to rule out the possibility that the results were simply due to lucky timing. The outperformance came primarily from two sources. The first source was the quality screens. Among cheap stocks, the ones that passed the financial quality screens, demonstrating genuine financial strength and clean accounting, significantly outperformed those that did not. This confirms the importance of the defensive and quality layers in the model. Being cheap is not enough. Being cheap and high quality is what drives the exceptional returns. The second source was the composite valuation approach. Using the enterprise multiple and a composite of several value metrics, rather than relying on any single measure, produced significantly better results than single metric approaches. The combination of measures provided a more reliable signal of genuine cheapness, reducing the number of value traps and increasing the proportion of genuine bargains in the portfolio. Now, no discussion of backtesting would be complete without an honest examination of its limitations. Gray is careful to acknowledge these. First, past performance does not guarantee future results. market conditions can change. Academic research has sometimes found that once a strategy becomes widely known, the excess returns it produced historically begin to shrink as more investors attempt to exploit the same opportunity. However, Gray argues that the behavioral foundation of the quantitative value approach makes it more durable than many other strategies. As long as human beings remain emotional, as long as fear and greed drive market prices to extremes, there will continue to be genuinely cheap stocks available for the disciplined, systematic investor. Second, backtesting can suffer from what is called survivorship bias, which means that only the companies that survived to the end of the testing period appear in the data, while those that went bankrupt have been removed. Gray and his team took careful steps to address this issue in their testing, but it is a legitimate methodological concern that any serious student of backtesting should understand. Third, the actual returns available to a real investor implementing this strategy would be somewhat lower than the pure backtested numbers suggest because of trading costs, taxes, and the practical challenges of executing trades in the real world. Gray accounts for this in his analysis and shows that even after reasonable assumptions about costs, the strategy produces compelling risk-adjusted returns. Think about the long view. An investor who consistently followed the quantitative value approach over 20 or 30 years, staying disciplined through the inevitable periods of underperformance, accepting the discomfort of owning unfashionable stocks, and trusting the process even when it felt wrong, would have built substantial wealth. This is not a promise. It is a historically grounded expectation based on decades of data across multiple markets. This is where most beginners make mistakes. They look at a backtested strategy, see impressive historical returns, implement it, and then abandon it the first time it goes through a 2-year rough patch. The behavioral challenge of maintaining discipline through underperformance is the single biggest obstacle between most investors and the returns the strategy can deliver. Here is the final psychological insight of this entire book. The investors who consistently outperform over long periods of time are not the ones who are smartest or most connected or most creative. They are the ones who have built a sound process, understand it deeply, and follow it with disciplined consistency through every kind of market environment. They are the ones who have replaced the unreliable gut feeling with a tested, evidence-based system. They are the ones who understand that investing is not about being right on any given day, but about being systematically positioned to be right over many years. And they are the ones who understand that the greatest enemy is not the market itself, but the emotional, impatient, overconfident investor who lives inside every one of us. Practical application. If you take one thing from this chapter and carry it forward, let it be this. Before you implement any investment strategy, study its historical behavior carefully. Understand not just the average returns, but the worst periods, the longest stretches of underperformance, the maximum drawdowns. Ask yourself honestly whether you could have maintained the discipline to hold the strategy through those worst periods. If your answer is yes, you are ready. If your answer is uncertain, spend more time studying the strategy before committing capital. The confidence that comes from deep understanding is what allows you to hold your discipline when everything around you is telling you to give up. Final reflection. The journey you have just taken. You began this audiobook in a crowded, emotional marketplace where intelligent people consistently make expensive mistakes with their money. You have now walked through the complete architecture of an approach that addresses every major failure mode in investing. You understand why human emotions destroy returns, and how a systematic process removes emotion from the equation. You understand why value strategies work, and have worked for nearly a century across different markets and different conditions. You understand how to protect yourself from companies with manipulated financials, from businesses on the edge of bankruptcy, from apparently cheap stocks that are actually value traps. You understand how to identify businesses with genuine competitive advantages, businesses with real financial strength, businesses that deserve to be owned for the long term. You understand how to measure cheapness accurately, using the most powerful valuation tools available rather than the most popular ones. You understand how to use confirming signals from insiders, short sellers, buybacks, and institutional investors to add confidence to your investment thesis. And you understand how all of these pieces fit together into a single, coherent, tested model that has demonstrated compelling historical performance across decades. This is a genuine toolkit for wealth building. But as with all tools, its value depends entirely on how you use it. The quantitative value approach is not a magic formula. It requires patience. It requires discipline. It requires the willingness to do what feels uncomfortable in service of what the evidence says is right. There will be years when everything you own looks unfashionable and everything you avoided is soaring. These years will test your conviction. Hold it. There will be years when the market is falling sharply and every headline suggests that the entire financial system is broken. These years will test your courage. Hold it. There will be years when a friend or colleague tells you about a stock that has tripled in the past year and asks why you are still holding boring, unfashionable businesses. These years will test your character. Hold it. Because on the other side of that patience, that discipline, and that courage is a body of evidence stretching across nearly a century, across dozens of academic studies, across multiple geographic markets and economic regimes that says the same thing. The disciplined, systematic, value-focused investor wins over the long run. Not every year, not every quarter, not every month, but over the long run, consistently, reliably, and with a margin of victory that compounds into genuinely life-changing wealth. That is the promise of quantitative value investing. That is the legacy of Wesley Gray's work. And now it is yours to apply. Begin where you are. Learn every concept until you understand not just what it says, but why it works. Build your process before you invest a single unit of currency. Test your own psychology before you test the market. And when you are ready, take the first step. The journey of 1,000 miles begins with one step. The journey to financial independence begins with one sound, systematic, evidence-based investment decision. You now have the map.